Hello and welcome to another episode of Investment Acorns, our exclusive series featuring insights from WhiteOak Capital Asset Management Limited. Joining me today is Aashish P. Somaiyaa. He's CEO, WhiteOak Capital Asset Management Limited. Welcome, Aashish.
Hi, thank you. Thank you for having me, 𝗔𝗯𝘂𝘁.
Good to have you back with us. Now, let's begin today's conversation with your column, Managing Portfolio Risks Amid Macro Uncertainties in Wealth Insight January 2025 issue. So you mentioned that many investors are preoccupied with macro predictions, be it political shifts or global developments. So why do you believe this approach falls short, and how can they shift focus to what's actually within their control?
Basically, what happens is that whenever we travel, I've been in the industry for now nearly 25 years. And one of the key parts of my role, apart from managing, operations and service, compliance, and, so many functions that one has in an asset management company. One of the key roles is also to travel and meet investors and meet mutual fund distributors, advisors, wealth managers within India, sometimes outside. So in all of this, what happens is that a permanent feature of all these meetings is, people asking that what do you think is going to happen in the markets? And it is always prompted by some or the other macro development, right? See, sometime back it was, what will happen if NATO admits Ukraine into their fold,
Yeah.
And if you go back, like 30, 40 years, you go time immemorial in history, what you will realize is that there has always been some or the other topic to discuss and worry about, correct? And still the Sensex or the Nifty has been, inexorably just climbing up and up. And it is a well-known phrase that markets always climb a wall of worries. Also, the other important point is, that let's say that if I were to meet you and let's say you are my investment advisor, and if I ask you, 𝗔𝗯𝘂𝘁𝗲, what will happen to my portfolio if Mr. Trump becomes president and, if he changes some things about tariffs and about policies? Now, look, if my portfolio is out of balance in terms of its asset allocation, right? If my portfolio is fully dependent on, say, small caps and mid caps and thematic funds and sector funds, then basically you will surmise that my portfolio has a high beta, it has a high volatility, right? And my portfolio has been created in a way that it cannot withstand any volatility in the market. First sign of trouble, and it will actually exhibit large volatility on the downside. So the obvious point is that, look, if your portfolio is out of balance, if you have a highly volatile portfolio, you are standing on an edge, and then you are saying that what will happen to my portfolio if XYZ ABC plays out. I mean, I always tell people on a lighter note, my son is 5 years old. Okay. And I'll give you one instance which will explain to you what exactly I'm saying about markets and investors. So, the people who take care, make food at home and take care of my son, they belong to eastern part of India, Siliguri and Bengal and Nepal border. Now, you know that, when you say you eat momos or noodles, these part of the country, they eat very, very spicy food, right? You must have had those red chilies and those kinds of things. Now, once I saw that, they were having those noodles which were extremely spicy. And there is a video of my son insisting to the maid that, I want to eat these noodles. So she said, beta, it's not for you, it's too spicy. He insisted on eating it. And then he started crying the moment he ate it because it was very spicy. So they took away the plate from him and said, okay, see, you're not supposed to eat this. But then he is insisting on eating it. So, he's crying also and he's eating those noodles also. Now, obviously, we are not here to discuss my son, but you can imagine that, what do investors do? When it comes to investing, they don't practice asset allocation. They want highest possible return. In the last 1 year, if you see Amphi data, all the money actually has gone to thematic funds, sectoral funds, small cap, mid cap, multi cap, right? Now, you are eating, मतलब आप तीखा खा भी रहे हो और रो भी रहे हो. So, you're worried about markets, but you're not willing to do anything about your asset allocation and where you're investing. So it's that kind of a situation. That's why I say that, there's too much discussion about what will happen in the markets rather than thinking about what is in my portfolio and how it will actually react.
Right. So the natural question, the next question is, you've also written that the risk is never in the market, it's in your portfolio. So what are some practical steps that investors can take to make their portfolios more resilient to unexpected macro shocks?
See, I think first is that, everybody overestimates their risk appetite. And, there are times when they underestimate their risk appetite. So, but those are very few times. Given that markets have rewarded people handsomely in the last couple of years, there has been extreme volatility, but with every volatility, market has bounced back sharply. Let me put it that way. And that starts, that makes people believe that, okay, I mean, this fine, we are making 20-30% compounded return. And, volatility, I can tolerate volatility. I have seen volatility. But, people haven't seen any period where market remains where it is for 6-9 months and, really tests patience. Correct? So what I've seen is that generally people feel that, I can manage risk, I can manage volatility. I have seen enough, but you haven't seen enough till you actually your patience gets tested. So what people need to do really is that they need to practice asset allocation. They need to understand their risk appetite more in terms of need for liquidity, more in terms of situational thought process. That okay, if 100 becomes 80 and remains there for 12 to 18 months, then what will it do to me? They need to think back how they felt in March 2020. They need to think back how they felt in May 2022 when Nifty suddenly fell to 15,200, oil went to $130, etc. Right? So you need to revisit how you felt at each of those junctures when your portfolio was down 20, 30, 40%, right? And then think that how would I have reacted, not if it bounced back, how would I have reacted if it remained there for 9, 12, 18 months. Correct? So people need to do some scenario analysis in their own minds and not assume that this is how the market works, 20, 30% compounded is the way it should work, etc. I think those are wrong beliefs. We should be open-minded and we should think how we will react if there are surprises. The other important thing is, always to keep in mind the base rates. The base rate is that over 32%, over 30 to 32 years since India's market liberalized, the long history is that Sensex compounded 14%. So 20-30% is not the base rate. It's not the order of the day. The second thing, if you take another example of base rate, if you take the entire market capitalization, on an average, 65 to 70% of our market is large cap. 70-80% of our market is not small cap and mid cap. Pareto principle is very much at play. On an average, 50-60% of our market and earnings component is bank, IT, pharma, consumer, these big sectors. It's not PSU, defense, railway, and infrastructure. Correct? But see, in the last 3 years, everybody's portfolio is cyclical, high beta, PSU, railway, infrastructure, small cap, mid cap, energy, utilities, right? So you can see that everybody's portfolio is away from the center of the market. Everybody has lost sense of base rates and lost sense of balance. So you need to align your portfolio more where you're more accepting of the base rates and the long-term trends and not start believing that, PSU is probably 10-12% of the entire market.
Right.
Right. The market is, defense, railway, energy, utilities, these are not like 30-40% of the market. Correct? So what is the base rate? Where is the market and where you have been allocating? Is your portfolio in the market or in some corners, cracks and crevices of the market, operating in some tiny sliver? All of those things people need to be mindful about and bring the portfolio back to the center.
Right. Like you said, people underestimate their risk appetite. Many portfolios today are heavily tilted towards cyclical, small, mid-cap stocks. So what are the early warning signs investors should look out for to rebalance in time?
So, Ruchira, it's already evident. See, look, if you look at, say, last 6 to 7 months, like the market had a big crack when the election results came, and then the market recovered. Okay. While market recovered, one thing I don't know how many people have noticed, but in the last 6 months, the market hasn't fallen as much. Market even recovered, and recent times there is a correction. But if you take 52-week high, from 52-week high, Nifty, small cap 250, mid cap 150, all of these are said 11, 12, 13% down from 52-week highs. That's not much. I mean, every year such a bout of correction happens. But what people should notice, while the Nifty, small cap, mid cap, all of that is 11, 12, 13% down from the peak, the so-called consensus sectors like defense, PSU banks, PSU, energy, utilities, they are 25 to 30% down from their 52-week highs, right? And in the same time frame, the non-consensus sectors like say pharma, IT, they are up 20, 30% from their bottom. Like everybody thinks that financial services and banks, not much is going to happen, but they have massively outperformed. The financial services index hasn't fallen as much in last 6 months as some of the other so-called popular sectors. So these are clearly early warning signs on your question that, everybody is thinking about correction. There's not so much of a correction. It's more of a very violent sector rotation that has actually played out in last 6, 7 months. So these things tell you, how things are changing. In the first few days of this correction, like in the fag end of 2024, large cap was underperforming. Large cap was falling more. But last few days, small and mid cap has fallen more and kind of wiped out the deficit completely. Now everything has fallen as much. So these are signs of, where there is relative value and how the market is shifting signs.
You also pointed out how investors take comfort in post-event explanations, even though they're too late to help. So how can they move from reacting to events to managing their portfolios more proactively?
So I'll give you 2 examples of this very interesting thing. See, I'll give you an example. First example, in the last 4 or 5 years, we've seen very violent, if you look at mutual funds, we've seen very violent rotation of best performing funds, fund managers, and fund houses, right? If you see before ILFS default, before COVID, it was more the, you saw more growth oriented. Wherever you had growth, those were the funds and fund managers and sectors that were actually doing very, very well. So, mortgage finance, NBFCs, low interest rates. So NBFCs did well. Home finance did very, very well. Because rates were low, liquidity was high, small cap, mid cap did very well. So anybody who had these kind auto ancillaries, these kind of things were doing very, very well before ILFS default. Then you saw 2019-20, it was more about defensive quality. And when COVID happened, it became very clear it was all consumer, FMCG, digital companies, pharma companies. So it was quality. So first growth, small and mid cap. Then quality did very well. Small and mid cap did badly. Then come 2021, small and mid cap started firing up in a big way. And instead of quality, it was more cyclical, value, those kinds of, policy-driven sectors, macro-driven sectors, those things outperform, correct? So in the last 4 or 5 years, you have seen massive churn in terms of best performing funds, best performing styles, best performing fund managers, correct? And then, as a result of this rotation, people have become more conscious to the fact that when different factors, change in the market, growth, quality, beta, size, meaning large cap versus small cap, so now what people think that, okay, it seems that certain factors are driving performance. So, we should do more factor-based investing. Let's buy more factor-based funds. Now, this is the first example of a fallacy. What happens is that human beings, all of us, when we learn something, that, this is the cause and effect. Okay. When we learn something about it, we don't just store that information. We think that, okay, this is how the world works. So now let's do this. See, just because you have understood that some people were getting outsized alpha because of inherent factor bets in their style of investing. So understanding doesn't mean that this is how it will play out in future and this is how you should. It only means you have understood the past. It doesn't mean that you have got the capability to predict the future. In fact, my understanding or my learning is that predicting which factor to bet on is as complex as forecasting markets. Predicting which factor to bet on is as complex as picking the right fund manager. If I were to draw any inference out of this, I would only draw one inference, that when suddenly some fund manager or fund house goes number one on alpha, suddenly from nowhere, like rise like a phoenix, it only tells me one inference, which is that people who have outsized exposure to certain factors, they suddenly become number one. And people who have outsized exposure to certain other factors, they suddenly become number 20. And people who have a broad, balanced portfolio, they don't swing as much for the extremes. So the learning is about consistency. The learning is not that you should be in the right factor at the right time. So what happens when people understand the past, instead of storing that information for processing, they start, very quickly to jump to conclusions that, okay, now let's identify which factor will work. The learning is not that factors have always been driving performance. When macros change, which factor is at play will change. So you're not going to be able to predict which is the next factor to play. The only learning from that is that you should not be having outsized factor bets, because it infuses a lot of inconsistency and volatility in performance, right? So that is one thing. The second thing I've seen, which is related to this, is that, when people get a good explanation or understanding of the past, they feel that they can sleep comfortably, they feel peaceful, and, they just, it's just a closure in the mind. But that doesn't mean it's going to change your performance or improve your portfolio, right? Again, another example of drawing wrong conclusions. So let us say that you can see now that the dollar is, appreciating significantly, rupee is depreciating, it is infusing a lot of volatility in our markets. And, you can see that suddenly 26,200 on Nifty, in a matter of 2-3 months, we are down about 12-13%. So what will happen is that somebody might think, oh my God, we were supposed to be on a roll. I was reading predictions about Nifty becoming 30,000. Why is it we are going in opposite direction? So then some, talking heads will be trotted out to give explanations. And then they will say that, okay, yes, we deserve to be 30,000, but temporarily, Trump transition, blah, blah, blah. We are expecting dollar to appreciate. We are expecting China to devalue the currency so that they will overcome tariffs. And India also has to have a competitive devaluation, otherwise we'll become incompetitive. So, all these explanations will sound very smart, but they are what they are. They are post facto explanations. Now, what happens is that when you give somebody a sound explanation for what is happening, they get impressed, right? And they themselves feel empowered, and they themselves feel knowledgeable about it. And then that understanding of what is happening makes them believe that they can negotiate the future better. The only way to negotiate the future better is to follow asset allocation and make sure your portfolio is not sticking out in any direction or any corner of the market. Explanations are only to make you feel better, but explanations don't improve your performance, right? So whether it is factors or macros, whenever something plays out, very good explanations are given. Those explanations make you feel better. They make you feel empowered. They make you feel that you understood what is happening. But none of us should be under the illusion that just because we get a perfect explanation of what happened in the past means that we are going to be able to negotiate the future better. The future is always going to be uncertain, and uncertainty can only be overcome by right asset allocation.
Right. You also compared portfolio management to sticking to a football formation, stick to your formation and play the strategy, you said. So could you share practical advice for investors to maintain discipline in their strategies, even during turbulent times? Because it's easier said than done, that stay calm and, carry on. But how can one do that really?
See, I think, we spoke a couple of times about asset allocation. Like I said, the only way to negotiate uncertainty is to do asset allocation, right? And why a football team has a particular formation? Because you cannot be too deterministic. You can only be deterministic about what you want to do, but you can't be deterministic about how your competition will respond or what their strategy is. You can be deterministic about your own strategy. But isn't it obvious that if your competitor overwhelms you with their strategy, then you need to be flexible, you need to go back to the drawing board, you need to rethink, and you need to approach the game differently. That is why there are breaks and half times. Correct. That's why now you look at portfolios. Correct. So if I say, a lot of times, now I'll give you an example. There is a fund we manage which has, like significant exposure to gold, like say 20-25% exposure to gold, 20-25% exposure to equity, and say rest is fixed income. Just giving you an example. Now, many times when people say that, okay, how is your fund currently allocated? So I tell them, okay, 25% gold, blah, blah, blah. So they will come back and say, but don't you think gold has really run up a lot? Why do you still have 23% in gold? I think gold is going to come down now. It's already done what it had to do. So then, what is the fallacy in this question? You're doing asset allocation with a predetermined thought process that gold is going to do badly. So then make it zero. Then don't do asset allocation. Put all your money in equity. Right? So see, asset allocation can never be practiced, or a open-minded strategy that, okay, this is my strategy, but if the competition throws this at me, this is how I will rework. Right? All of this, whether it is asset allocation or responding to a competitive landscape or responding to your opposing team, all of this can be done only by open-minded people. People who are deterministic. See, like, when you look at an asset allocation product, and if your first question is that why are you holding 23% gold, correct? That means you are not somebody who is open-minded about asset allocation. That means you are deterministic that gold is going to go down, so then equity is going to go up, right? The point of asset allocation is that you're not concerned with the performance of any one asset class. You're only concerned with lack of correlation or cushioning of volatility amongst asset class. I mean, they just have to behave in an uncorrelated fashion. So why do you have gold and equity both in your portfolio? Right? Because there will be times when equity will disappoint, correct? And your portfolio will run the risk of falling 20, 30, 40%. At that time, generally it has been observed that gold doesn't fall or even might act as a volatility dampener in your portfolio. Now, what is the importance of dampening volatility? You may be very deterministic, you may be very bullish, and you may be, all of us are thorough believers in Amrit Kal. There's no question that we are not going to see it. We are going to make it happen. But it's not going to happen tomorrow morning, and we're not going to get there in a straight line. Every year from the top, market falls 15-20%. Is it necessary that my portfolio also should fall 20% and go with the vagaries of the market? There are techniques available whereby you can dampen the volatility, and if you dampen the volatility, it will ensure that you don't react emotionally. See, everybody says be greedy when others are fearful, be fearful when others are greedy. ये theory है, बोलने के लिए अच्छा है, but ultimately, yeah, easier said than done. But if your portfolio falls, I mean, in March 2020, everybody was fearful, correct? So what happens is that it's very important to dampen volatility of portfolios, because if you do not dampen the volatility of a portfolio, which can only be done by open-minded people, by the way. People who are deterministic, they don't cater to all of this. Why it is important to reduce volatility in a portfolio is because if the volatility is fully exposed to volatility, then it will go for the extremes. And what I've seen is that when you expose people to extremes, that's when their emotions come out. See, greed is an extreme emotion. Fear is an extreme emotion. Envy of your neighbor's returns is an extreme emotion. Correct? All these extremes come out. All these emotions come out only when portfolios are exposed to extremes. And when emotions come out is when you make mistakes. So the best is, however deterministic you may be, the best is you make sure that you don't invest in a way that the market vagaries will bring out emotions. Because if your emotions are exposed, you're highly likely to make a mistake.
All right. Well, thank you, Aashish, for sharing your insights and diving deep into your columns with us. We look forward to having you again. Thanks.
Thank you. Thank you very much.